today's call so you can learn a little bit more about the Kingdom K. My name is Cassie Lehman, and I am the president of Beacon Wealth Consultants. And today our call is going to be led by Hillary Sunderland. I would ask that everyone be on mute for the call, and then towards the end, once Hillary's finished up, we will open it up for questions. Now, many of you had a chance to meet Hillary Sunderland when we were at the Kingdom Advisors Conference. If you didn't, her bio is up for you right here. Just an extra fun fact I will add, many of you know Martin Wilde from Eventide, and Hillary worked with Martin at Eris for a number of years, and she is really passionate about biblically responsible investing and has also been doing that for a number of years. The Kingdom K is something that Rick and I, so Rick Lehman is the CEO of our company, and it's something we were dreaming about for years, and it took Hillary to really take that vision and make it a reality. So Hillary, I'm going to turn it over to you.
All right, thanks Cassie, and thank everybody for joining us today. I hope that you leave this webinar enlightened about our new product offering, and as Cassie mentioned, we will open it up for any questions near the end. So let's just go ahead and get started. What I want to do is first, here we go over, I just want to tell you a little bit about what we'll be covering here in the next 30 to 45 minutes or so. First is the opportunity as we see it. We'll talk a little bit about fiduciary responsibility, because that is a big talking point right now because of the Department of Labor and the political surroundings of the 401k platform. We'll talk about how we do BRI screening, how we have structured the platform using our investment policy statement. We'll talk about participant-directed options, qualified default investment alternatives, model portfolios, dive into a little bit about fees and expenses, next steps, and then, as I said before, open up for any questions that you may have. So let's go ahead and dive right in. First, we want to talk about the opportunity, because we see this this is a great time to start looking at the retirement business. If you're not currently doing it, or even if you are doing it, there's a lot of moves right now in the industry that makes this a really right time to gather more assets, and especially on the BRI side. This is a survey from 2017, it's Fidelity's Retirement Plan Survey Report. And the interesting thing is that the number of plan sponsors searching for new advisors is at a record high. And some of the key reasons for changing is that advisors, or plan sponsors rather, are saying that they need a more knowledgeable advisor, someone who can keep them informed of regulatory changes, consult with them on fiduciary risks and responsibilities, give them suggestions for improving plan performance, help in minimizing costs, and also provide them with insight into participant trends and behavior. So you have 38% of plan sponsors who are actively looking to switch their plan provider, and these are the reasons why. And the interesting thing is that if you look at their top reasons for hiring one particular advisor over another, 37% are concerned with fiduciary responsibilities, 27% say their company has grown and their plan is more complicated, 26% say they need help with plan investments, 7% want a better understanding of how well the plan is working for employees, and 2% have less time to devote to the plan. And the interesting thing here is that fiduciary help is at an all-time high as a lead answer. 37% of plan sponsors are currently concerned with fiduciary responsibilities, and a lot of that just because of the political environment and recent rulings by the Department of Labor. So first, we're going to start by diving in a bit to the fiduciary responsibility side. I know compliance isn't always something that we want to talk about. It's not exciting, but it's an important selling point for this platform as you go out to clients. So let's talk a bit about that. A lot of fiduciaries, a lot of plan sponsors rather, don't even know what level of responsibility that they have. So I'm going to give you an example here, and you can think through this. So Mr. Moneymaker is an advisor for XYZ Company's 401k plan. And Mr. Moneymaker regularly reviews the investment options in the 401k plan under suitability requirements and makes recommendations to the plan sponsor, Mr. Deep Pocket. Now, say a plan participant brings about a lawsuit against XYZ company over poor performing mutual funds. Who has the liability? Well, when you ask plan sponsors this question, a lot of them would say, well, Mr. Moneymaker would. That's the advisor on the account. However, when you look at the law, if Mr. Moneymaker only gave recommendations to Mr. Deep Pockets, and Mr. Deep Pockets had the discretion to take or disregard the recommendation, then Mr. Moneymaker is probably not acting as a fiduciary and offers no practical protection from liability from Mr. Deep Pockets. And this is an important point, because even when the plan sponsor adopts all of the advisor's recommendations for the plan sponsor, they can still retain all the fiduciary responsibility and liability for those decisions. And many plan sponsors don't realize that. And it's important to note that to plan sponsors, because failing to properly manage a plan and its investments can result in personal fines, penalties, and financial liability. And so this is why, fiduciary concerns is one of the top concerns of plan sponsors today, is that they don't want to have this type of exposure by offering a 401k plan to their company. So there are two different types of statuses, I guess you could say, for fiduciaries. One is an ERISA 321 fiduciary, and this provides the standards by which any individual performing services for the plan might become a fiduciary due to the functions they have the ability to perform. So if an advisor can be a 321 fiduciary if they exercise any authority or control over management of the plan, the management and disposition of assets, if they render investment advice for a fee, if he or she has any responsibility in the administration of the plan, if he and she is named in plan documents. And so a 321 fiduciary shares some of the liability related to investment decision-making with the plan sponsor. However, it's still not the level of protection offered by a 338 fiduciary. And this is where Beacon Wealth comes in here, because we're offering our Kingdom K platform as a 338 fiduciary. So let's take a look at that example again from a 338 fiduciary standpoint. So a 338 can be a bank, insurance company, or a registered investment advisor. And a 338 fiduciary takes discretion, authority, and control of the plan's assets. So basically, under a 338 fiduciary segment of the 401k industry, a 338 assumes the legal responsibility for the decisions it makes. So basically, Beacon Wealth, as a 338 fiduciary, is responsible for selecting, monitoring, and replacing of investments. And this allows the plan sponsor to really manage and mitigate their fiduciary risk because they've appointed someone else. They basically outsource that function to somebody else. Now, it doesn't mean that they get rid of all of their liability. They still have responsibility for selecting the 338 investment manager and making sure they're monitoring and benchmarking that manager over time. However, it does mitigate quite a bit of their fiduciary risk. So going back to that example, if Mr. Moneymaker is the advisor for XYZ company's 401k plan, and he or she regularly informs Mr. Deep Pockets of changes that Beacon Wealth Consultants has made to the 401k plan, Mr. Deep Pockets does not override any of Beacon Wealth's investment decisions, and then a plan participant brings a lawsuit against the company over poor performing mutual funds. Who has the liability? Well, in a 338 case, because we are acting as a 338 fiduciary, Beacon Wealth Consultants takes on the liability for those decisions. And this is one of the big differentiators, because remember, the willingness of plan sponsors to take on formal fiduciary duties is very important today. From the Fidelity Retirement Plan Survey in 2017, 60% of plan sponsors stated that they want advisors to willingly take on formal fiduciary liabilities. And so by partnering with Beacon Wealth Consultants, you can easily address the number one concern that plan sponsors currently have, and that's the liability they're taking on because we are acting as the 338 investment manager. And in addition to that, the other thing that we're providing is that not only are we mitigating the plan sponsor's fiduciary risk, we're acting in a fee-only capacity, which is very important to plan sponsors today. We are acting in the best interest of the client. And in addition, we're offering BRI screening on the model portfolios that we offer. So now I'm going to switch gears a bit from the fiduciary landscape, now that you know that we're taking on a lot of the risk for the plan sponsor. Let's talk a little bit about BRI screening. Now, this is a big differentiator of the Kingdom K platform, especially for Christian business owners, because a lot of Christian business owners are interested in biblically responsible investing, and a lot of them don't even know that it exists. So let's take a look at, is this okay to even do? So based on some older Department of Labor interpretive bulletins back in the 2008 time period, many people believe that screening is incompatible with ERISA's fiduciary obligations. In the past, around 2008, the Department of Labor construed the requirements that a fiduciary acts solely on the best interest of plan participants and beneficiaries, and many people read that to mean that prohibited a fiduciary from subordinating the interests of participants and beneficiaries in their retirement income to unrelated objectives. So the Department of Labor calls this collateral benefits. Screening, whether it's from an SRI perspective or a values-based perspective, to the Department of Labor, they're known as economically targeted investments, ETIs, or ESG factors. And they've stated in the past that because these things you're looking for, these different values that you're screening for, is an unrelated objective, that may not be compatible with your fiduciary responsibility. So this has been the background that we're coming off of. However, what many people don't realize is that in 2015, the Department of Labor issued an interpretive bulletin which stated that they unduly discouraged fiduciaries from considering ETI and ESG factors. And under this myth one here, the items in quotes, these are actual quotes taken from their interpretive bulletins. So they stated in 2015 that planned fiduciaries may invest in economically targeted investments, and biblically responsible investing falls under that heading, based in part on their collateral benefits, so long as the investment is economically equivalent with respect to the return and risk to beneficiaries in the appropriate time horizon to investments without such collateral benefits. And additionally, the department does not believe that ERISA prohibits a fiduciary from addressing ETIs or incorporating ESG factors into investment policy statements. So while in the past it was construed that you could not do it, in 2015 the Department of Labor came out and said that you can. And so we just want people to be aware that this is something you can definitely step into on the ERISA side. And then the other myth that kind of comes along with this is that some funds that are biblically responsible do have higher embedded expenses because of the screening overlay that's employed on the funds. So in this decompression world, a lot of people say, well, because they have higher embedded expenses, it's unsuitable for a 401k plan. And we just need to push that aside. That is a myth, because the fact is that courts have consistently recognized that fees are just one dimension to a plan's investments and should not alone be the basis on which an investment selection is judged. This is similar to just like any other actively managed mutual fund. You can have actively managed funds within a plan because ERISA judges fiduciary obligations based on prudence, and fiduciary prudence focuses on the process by which investments are selected and managed, not on the plan outcomes. So as long as you have a process in place and you're consistently following that, that is what is important under ERISA, not necessarily the headline expenses within a fund. So
Hillary,
that being said,
Hillary, before you go on, could
yep.
you review again ETI and ESG and what those stand for?
So, yeah, ETI stands for economically targeted investing, and ESG is a segment of SRI. You can look at it that way. Environmental, social, and governance factors. So basically, those are the two headings that the Department of Labor uses in their interpretive bulletins. However, it states in their interpretive bulletin that values-based investing is underneath ETI and ESG. So there's a lot of initials I'm throwing out here, but they all basically mean the same thing to the Department of Labor. Okay, so that being said, so we've learned that we can use BRI within an ERISA plan, but we still need to recognize that this is a bit of a different landscape. Because on the wealth management side, you have a personal relationship with an individual. And so if you're selling a portfolio that is based in biblically responsible investing, the individual client is actually authorizing the screening of it, the BRI investment strategy. However, in a 401k plan, your relationship is with the plan sponsor. And just because the business owner may be a Christian, we'll take Hobby Lobby as an example, just because the business owner, the owner of Hobby Lobby is a Christian does not mean that every cashier who works for Hobby Lobby is a Christian and wants to have a biblically responsible investment portfolio. In a 401k plan, we need to give participants choices. And so what we've designed here is basically 3 different parts to the Kingdom K platform, and I'll walk through each of them individually. The first is a suite of participant-directed options. We also offer qualified default investment alternatives and the BRI model portfolio. So in terms of the biblically responsible investing aspect of the Kingdom K, that comes in the third leg here, the model portfolios that we're offering. However, because some plan participants may not want to have a screened portfolio, and we need to support them as well, just given the rules around the Department of Labor, we're also offering participant-directed options and qualified default investment alternatives that are not biblically responsible. So I'm going to start by going through kind of, as you sign up plans with our Kingdom K platform, what will they receive? What does this look like to a plan sponsor and to you as the advisor? So one of the first things to consider is that among a plan sponsor's responsibility is to offer investment options to participants, sound investment options. And using an investment policy statement not only helps the plan sponsor to think through how to best fulfill this important fiduciary duty, but it's also one of the most powerful tools available to protecting a plan sponsor against liability, because an IPS formally sets forth the objectives, restrictions, and general investment structure for the management of the plan's assets. It provides the basis for evaluating the plan's results. It documents the process used to select and monitor the plan's investment selections. So because of this, because the IPS very much protects the plan sponsor from liability when it is written well and it's consistently followed, Beacon Wealth requires each plan to use an investment policy statement to mitigate liability concerns. We will provide one to the plan. And then the advisor just needs to make sure that the IPS is consistently followed, which we also help you to do. This is one of the first things you can do when you're going out and prospecting for a plan is ask them, do you have an investment policy statement? When's the last time you reviewed it? Is it consistently followed? There are many investment policy statements I've seen over the last, decade plus that I've been doing this, where they've been very poorly written investment policy statements, or a plan may not have one at all. So by being able to go in and provide one directly to the plan participant, and then in addition, then manage everything to that investment policy statement, that's a nice value add for your plan sponsors. So let's start by talking about the first leg of the Kingdom K platform, and that's the participant-directed options. So participant-directed options are if a client wants to basically build their own portfolio with underlying investment options. These are the options that are available to them. And the IPS spells out, exactly what we're looking for. And these are, common things. If you're in the 401k industry, you know what you look at: regulatory oversight, stability of the organization, correlation to peer group, risk return statistics, attribution analysis. Those are the things we're looking for in terms of picking participant-directed options for a plan. So that'll all be thought out in the IPS, and I'll show you later on in the presentation then how we monitor that over time and provide due diligence back to the plan sponsor. But with the participant-directed options, what we have is basically 12 asset classes that were carefully chosen to help minimize behavioral biases. If you're a student of behavioral finance, which I am, you'll read a lot about how behavioral biases can really wreck a 401k plan. And so these were carefully chosen to help minimize some of those biases, and I'll talk about that in a minute here. But basically, there's 12 asset classes under fixed income. The plan will have access to money market, intermediate term bonds, global bond, inflation protected bond, and a high yield bond, equities, your domestic large, mid, and small cap, foreign large blend, emerging markets, and then REITs and commodities are also offered as asset classes within the participant-directed options. Some of this goes back to, like I said, the behavioral biases are embedded in 401k plans. And here's a picture of a buffet, and we're getting close to dinner time here on the East Coast, so it looks quite tempting right now. But one of the things to think about is if you were going to this buffet line, what would you choose to eat? And I think if all of you are responding right now, what you'd probably say is you'd end up taking a little bit of everything. And you do that because you don't want to accidentally miss out on the restaurant's best dish. It's really a reasonable way to avoid missing out, because missing out is comparable to losing. And this is a strong behavioral bias known as loss aversion. And even when performing simple tasks like picking food at a buffet, loss aversion kicks in, and it drives you to diversify, which at a buffet is fine because you can always go back and get more of what you like. However, this is also very much present within 401k plans. And it's an issue in 401k plans. If you choose wrong, you don't really have a do-over. You can't just go back to the buffet. This is something known as naive diversification. So when making complex decisions that involve multiple options, people tend to diversify out of fear that they'll make the wrong decision. And in a 401k plan, this is called the naive diversification heuristic, or 1/n diversification. And what that basically means is that your asset allocation is heavily dependent on the retirement plan structure. So if you look at a 401k plan and there's 10 investment options for participants, and 9 of them are equities and 1 of them is a bond fund, and then you look at the overall asset allocation of that plan, I would bet you that it's close to a 90-10 allocation. What people do is if there's 10 options, they'll do 1/n, so 1/10, 10%. They'll put 10% into each option because they don't want to make the wrong decision. So I'll just put a little bit into each. Richard Thaler and Shlomo Buntazi researched naive diversification retirement plans and found that allocations to stocks versus bonds is highly correlated to how many stock mutual funds are offered in the plan. And so that's why we have those 12 asset classes selected very carefully, because we know that people exhibit this bias, and we want to improve plan outcomes for plan participants. So one of the things you can do when selling a Kingdom K plan is, go out to them and try to get the plan's lineup. We can help you come up with talking points. There's been many plans I've seen over the years where they'll have, 20 different investment options, and there's maybe 3 bond funds, and the rest are, not very well diversified equity funds. And so these are really easy ways to gather assets and to make the sale whenever you're going out and prospecting for plans. So again, these 12 asset classes that we've selected allow a participant to arrive at basically a balanced asset allocation with appropriate domestic to international exposure if that 1/n diversification is employed. So basically, we're trying to improve plan participant outcomes by backing them into the right asset allocation should they choose to manage their own account. And this is important because there's also other areas where we can add value just by how we're designing this Kingdom K platform for participants. So 7% of plan sponsors want a better understanding of how well the plan is working for employees. And again, it's important to think about what you're offering to employees in the first place. So this is a picture. I'm sure most of you recognize this. This is a Coke Freestyle machine. And when they first came out and you went up to a Coke Freestyle machine, these were your options. Okay, and if anyone can do quick math here and can count very quickly, you would see that there are 125 different options that you can pick from just on the screen alone. And what Coke found was that people absolutely hated these machines when they first came out. And so they moved to this. So now when you go to a Coke Freestyle machine, there's 4 options. You want regular Coke, caffeine-free, low-calorie, or fruit-flavored, and then you go from there. And the reason for that is because people suffer from decision fatigue. People make decisions all the time, all day long, and when it comes to signing up for a 401k plan, they suffer from decision fatigue there as well. If you look at this list, this is just a list of all the categories currently offered in Morningstar. There are 102 possible categories that you could choose from within a 401k plan. So while you may run into plan sponsors who want to start adding in certain sectors, or they want, diversified Asia Pacific, Japan, China, while you can build out a lot of different asset classes, research shows it's actually the wrong thing to do for plan participants, and it's really the paradox of choice. As the number of choices go up for plan participants, you reach a peak and your happiness actually starts to decrease. And it's been proven time and time again that within 401k plans, too many fund choices lowers the rate of participation, and people who are overwhelmed are less likely to participate. So again, that's why we're offering just those 12 asset classes, those 12 major asset classes, in order to encourage participants to really start investing in the plan and have a good outcome for retirement. So within these asset classes, I'm not going to show you the actual underlying investment options, but just know that most of them are index funds. There are a few actively managed funds for asset classes where it makes sense to have an active manager. But most are index funds, which also substantially lowers the fees for plan participants. The second leg of it is the qualified default investment alternatives, or QDIAs. This will be pretty quick here, but for QDIAs, we're using target date funds, which are structured as fund of funds that utilize active management. So target date funds offer ongoing asset allocation, rebalancing, and investment management incorporated into a single fund, and the participants are automatically enrolled based on their age. The glide path adjusts over time as a participant approaches retirement. Okay, so the QDIAs are actively managed. So far we have participant-directed options, which are mostly passive investments, and QDIAs, which are active investments. And now the third leg goes into the model portfolios. The LightPoint Kingdom K model portfolios basically follow what we're already doing on the wealth management side. So to give you a bit of a background to our firm and how we're doing things, we have been doing, Beacon Wealth has been doing biblical responsible investing for 20 years. And we spent the last 20 years really embracing ideas that shape and refine our commitment to investment excellence over time. So we've been innovative and early adopter of different concepts and ideas and solutions. And this Kingdom K platform is just a segment of that. In terms of our investment management, we have an investment committee that governs the investment process. I'm a CFA, I'm a member of the investment committee. There's 2 CFPs on the committee as well. And we meet regularly to determine the forward-looking portfolio positioning. We look at key investment themes, views on the macro economy. We do manager due diligence and selection. We do both fundamental and technical analysis, so we're not bent toward one type of analysis or another. I'm a strong believer that one informs the other and vice versa, so it's important to have both within your investment process. And the other thing in terms of experienced investment management is the underlying allocations of the funds is really driven by research supported by Ibbotson Associates. And Ibbotson is widely known and regarded in the industry. They have over 30 years of experience in independent asset allocation research. So we rely on them for some of the asset allocation themes, and then our investment committee, based on our forward-looking view on investment themes and the economy, will make our own slight deviations from Ibbotson as we see warranted. And with how we manage the LightPoint Kingdom K portfolios, they're really dynamic in that they are strategic asset allocation portfolios, but they have active oversight. And so we can over and underweight different asset classes as we see fit. We do engage in multi-asset class investing. So the portfolios have fixed income exposure, which provides stability and lowers overall portfolio volatility. Domestic and international equity investments for long-term capital appreciation. And also, we like to insert differentiated sources of return, such as global credit, absolute return-oriented strategies, real assets, non-traditional bonds, to really help the risk-return profile of the overall portfolios. And we typically rebalance these portfolios 4 times per year. And then in terms of fund due diligence, whenever we're selecting managers for the portfolios, we look at 5 main categories: organization of the firm, the investment personnel, the investment process and philosophy, and is it consistently adhered to over time. We do a quantitative assessment of the underlying managers, and we also offer BRI screening on the portfolios as well. So let's talk a little bit about the BRI screening on the portfolios. We do exclusionary screens. We use Insogo Analytics. Here's a snapshot of one of the funds that's in our portfolios currently. And we use Insogo Analytics to look at a couple of main areas. And we try to screen funds to exclude ownership of companies that are engaged in business and philanthropic activities and activism that run counter to biblical principles. So things like abortion and pornography, we try to go for a 0% tolerance there. We try to screen out holdings of companies that are strong advocates of anti-family lifestyles, screen out predatory lending, and also those things that exploit human addictions, such as alcohol, gambling, and tobacco. These are all things that we take into consideration whenever we are choosing funds for our portfolios. Now, there are some asset classes that aren't well represented by the BRI industry, just because there's some asset classes where there aren't any BRI funds available. So in those cases where there's no investment manager available, or the one that is available isn't a good option from a risk-return standpoint, from a quantitative and qualitative due diligence standpoint, we will do the screens on more of a best efforts basis. So we will go outside of the BRI fund families into other fund families, but we still look for fund families whose investment process and philosophy will still allow for a fairly low to no exposure to these issues. So those are our exclusionary screens. We also like to focus on shining light companies. We like to do the positive as well. And so we proactively seek companies or fund companies that demonstrate strong servant leadership and that create compelling value through the products and services they offer. For those of you who have signed up for the Beacon Wealth blogs, we send out a Shining Light blog every Saturday that talks about one of the companies that we really like from a servant leadership perspective, and why we enjoy investing in those types of companies. So we do engage on the positive side as well. So that was the investment process and philosophy, and a bit about our BRI screening process. I could have a whole webinar just on that, but I just wanted to give you a snapshot. Right now, we're offering 6 risk-based model portfolios within the Kingdom K platform, all which have a BRI focus. So they go from a conservative allocation, which is about a 20-80 mix, up to your most aggressive allocation. So a lot of different options for plan participants depending on their overall risk tolerance. And in addition to that, we also offer a portfolio for cash balance plan. So a cash balance plan is a defined benefit plan under which an employer basically credits a participant's account at a set percentage of his or her yearly compensation plus interest charges. So it's a different way of, it's a different type of plan, and so it has to be managed differently So we do have a custom IPS just for cash balance plans that you can use. We target a return usually of 4 to 6% each year, and this is also available if you choose to utilize the Kingdom K product. So just to summarize our offerings, so we're offering the 338 fiduciary aspect, which is extremely important today to plan sponsors, and then really a three-pronged approach. We have participant-directed options, which are primarily index funds, provide passive management and low embedded expenses. We have qualified default investment alternatives, which are target date funds that are actually managed, that become more conservative as a participant approaches retirement. And then we have the LightPoint Kingdom K models, which are professionally managed accounts. They're actually managed by Beacon Wealth Investment Committee. We have the 6 risk-based models available. The cash balance plan model is also available, and also focus on BRI. So the really nice thing here is that if you have a Christian business owner who is interested in this, this is a very robust option. The Christians in the company can use the BRI portfolios. Those that don't want a BRI perspective can either do index funds or actually managed funds. So really, the participant, they can choose among a lot of different options. It's just not one or the other. It's all embedded within one package for them. Okay, just a couple more slides here, and then we'll go to questions. In terms of investment monitoring and reporting, so because we are the 338 fiduciary, Beacon Wealth is responsible for all the ongoing monitoring and reporting on the accounts. And within the IPS, we have a whole section that talks about how we monitor the different investments over time and report that back to the plan sponsor. And so what our plan sponsors and our advisors who use this program will receive is, on an annual basis, we'll provide a due diligence review kit. And this is just a snapshot. It's a pretty big spreadsheet here that just shows you a couple of different columns on this spreadsheet. But basically, you'll receive this review kit on an annual basis, which goes over every single fund that's in the participant-directed options and the qualified default investment alternatives, and looks at all the statistics and gives it a pass or fail score based on its adherence to the IPS. So things like, you can see here in column C, about a little over halfway over to the right, correlation to style or peer group. Each investment option should be highly correlated to the asset class of the investment option. We're going to look at those statistics and report back to you as to whether or not that fund is still adhering to its criteria or not. And then we will tell you whether or not the fund is on watch list status or if it needs to be replaced. So basically, once a year, the plan sponsor receives a whole due diligence kit that ties directly back to the IPS so that they can show, if they're ever audited by the Department of Labor, that they have a prudent process and that, in fact, was consistently followed over time. And for the model portfolios, what the plan sponsor will receive is a write-up that talks about the different changes that were made to the models throughout the year as well. And we also have fact sheets available that tracks the performance of those models over time so that the plan sponsor can assess us as a 338 investment manager from that perspective as well. So you're getting a complete due diligence kit delivered to your door, and obviously we're always available to answer any questions that you may have as well. Moving on to the fees and expenses, you're probably wondering, so this looks great, how much is this going to cost? Well, our fees are fully disclosed and competitively priced. Our technology provider, so the firm that's providing the administration and record-keeping services right now is Epic Advisors, and their services are custom quoted. It really depends on the size of the plan, how many participants you have, and the average account balance. That determines what that fee will be. So if you have something in mind, we can certainly give you a custom quote on that. Beacon Wealth Consultants, our fee is billed quarterly in advance based on the fee schedule shown below, which is extremely competitive for a 338 fiduciary option. And these fees can either be deducted from plan assets or billed to the plan sponsor so that they can take the tax deduction on that. There's also custody and trading costs as well. So right now our portfolios are at Charles Schwab. They charge a 2.5 basis point fee with a minimum fee of $400 per year. And then, of course, the embedded fund expenses. So whenever you're looking at mutual fund expenses, it's important on the 401k side to know exactly what you're paying in the end. So you may have a net expense ratio of, say, 70 basis points. But there's these things called shareholder servicing payments, or SSPs, which within our platform are credited back to the plan. So a fund could have an expense ratio of 70 basis points in shareholder servicing payments, which are traditionally the sub-TAs and 12B1 fees, which are then credited back. So if it's 70 basis points and there's 20 basis points of shareholder servicing payments, they're paying a net of 50 basis points. So we're crediting back all that sharing to the plan. We don't take any revenue sharing arrangements or soft dollars with any of these companies. Everything's credited back to the plan to really keep it competitively priced. And our plan minimum is $250,000. So next steps, if you're interested in kind of taking the next step and you can think of a few plans that this may be appropriate for, there's a picture of Cassie. Cassie is the person who introduced the call to us today. You can contact Cassie at her email address, which is listed there, for further information and discussion. It really depends in terms of working with us. It really depends on how you're currently set up, what custodians you have access to. So once we get a little bit more information on how you're currently set up and how you'd like to do business with us, then we can go down that road of getting everything in place for you to do so. And then once you're registered, once you're able to go ahead with any plans, once we clear the air on whether or not your current RIA or broker-dealer will allow you to do it, our proposal process is quite simple. You're going to just gather basic information from the plan sponsor, such as the plan name, total plan assets, the number of participants with a balance, and then we will come back within a few business days and provide you with an initial proposal, which will show all the fees, the investment selection, and really in some brochures that really help you sell that plan to the plan sponsor. And we'll also provide you with a side-by-side comparison. So here's just a snapshot. I apologize, it might be a little hard to see. But what we'll do is we'll take how they're currently set up with their current plan, if they have a current plan, and then compare that to Kingdom K to really illustrate on a visual basis to a plan sponsor. These are all the additional things you're getting by moving to Kingdom K. Things like moral values integrated to the investment selection options, like the BRI model portfolios, the 338 fiduciary aspect of it, etc. And then we will also, if you have the current fees on the plan as well, we can compare the current plan's fee structure compared to our offering, so that the plan sponsor can make a very informed decision about that.